$100,000, 10 stocks, 5 of the greatest investors who ever lived. We handed each of them the same money, the same 10 names, the same July 2026 numbers. One of these 10 walks away with more of the board's money than any other. Which one? Not the one you would bet on. And 2 of these legends give it a flat 0. We run their real documented methods, the coldest, most objective lens there is. Not hot takes, not financial advice, AI models of public methods. The board convenes in July 2026, 3 rounds. Their single biggest bets, the names they all refused, and the $500,000 portfolio it all adds up to.
Here are the rules of the game, $100,000 each. The same 10 names, the entire AI economy on one board. Allocate by your own documented method, and every dollar must be invested. No hiding in cash. 5 methods, 1 question, where does the money actually go? The 5 lenses in 1 line each. Graham demands a margin of safety. Munger concentrates into wonderful businesses. Lynch hunts growth at a reasonable price. Fisher buys research empires and almost never sells, and Druckenmiller rides the macro wave and sizes like it. The 10 names on the table: Nvidia, Microsoft, Oracle, Palantir, TSMC, Tesla, Meta, Broadcom, AMD, and Alphabet. Chip makers, 1 indispensable foundry, 4 hyperscale clouds, 1 pure software bet, and 1 wildcard priced on a promise. Together they are the whole AI stack. The silicon at the bottom, the one factory that fabricates nearly all of it, the clouds that rent it out, the software that sells it to governments and boardrooms. Own this board and you own the entire boom. But this same board spans the widest valuation spread in big tech, from roughly 17 times earnings at the bottom to about 190 times at the top. One of them trades near 50 times its sales. Same 10 companies, 5 lenses, watch what happens. Keep score as we go because the answers do not match. 1 name gets money from every single legend. 1 name gets the most. And 1 name, a company worth around $1.5 trillion, gets nothing from anybody. Round 1, each legend's single biggest bet. We start with the man who trusts arithmetic and nothing else. Benjamin Graham, Buffett's teacher, the father of value investing and the author of The Margin of Safety, the idea that the price you pay is the only protection you can truly count on. But run that rule across 10 AI giants and something strange happens.
The Graham screen runs 4 filters: a hard ceiling on the earnings multiple, price against book value, the real assets behind each share, a fortress balance sheet, and a long, unbroken record of dividends. Any stock that fails the arithmetic is not an investment, it is a speculation. Run those filters across this board, and the screen deploys $35,000 into Meta, the only near-Graham multiple in the room, with net cash and a new dividend. Then Alphabet, Microsoft, TSMC, and a toehold in Oracle. But Nvidia, the most important company of the decade, gets 0. At this price, the margin of safety simply does not exist.
35,000 into the 1 cheap name and a 0 on the stock the whole world owns. Log it, because the next legend calls diversification like Graham's absolute insanity. Charlie Munger, Buffett's partner and the board's concentration extremist. His model wants a handful of wonderful businesses bought at fair prices and watched like a hawk. Everything hard to predict goes in the too hard pile.
The Munger model asks 4 questions. Is it inside the circle of competence? Is the moat durable for decades? Is management rational and honest? And is the price fair? Fast-moving silicon fails question 2 on arrival. Nobody can know a chip moat 20 years out. So the model concentrates on quality, $45,000 into Alphabet, a search toll bridge with ungodly scale economics, $35,000 into Microsoft switching costs, 80% of the book in just 2 names, the chip makers, too hard, all of them.
Nearly half his money in 1 toll bridge, and every chip maker exiled to the too hard pile. The next man built his fortune doing the exact opposite, buying what he understood everywhere he looked. Peter Lynch, the mall-walking 10-bagger hunter who beat Wall Street from a shopping cart. His yardstick, growth at a reasonable price, and a story so simple you could draw it with a crayon.
The Lynch method classifies before it buys.
6 categories from stalwarts to fast growers. The PEG test, the earnings multiple divided by the growth rate. Near one is fair. And one standing warning, be very careful with the stock that everybody already owns. The result is the widest book on the board, 8 names in conviction tiers. 18,000 on Meta, a fast grower at a stalwart price. 17 on Alphabet. 15 on Microsoft. And here is the twist. Nvidia, a genuinely cheap fast grower on these numbers, gets trimmed to 13,000 because it is the most crowded stock on Earth. 8 names, tiered conviction, a deliberate trim on the hottest stock alive. The next legend owns 3 or 4 things and holds them for half a century. Philip Fisher, the original growth investor, the man who bought Motorola in 1955 and held it until the day he died. His question was never this year's multiple. It was, how big are the earnings a decade out?
The Fisher method runs 15 scuttlebutt points. Is the research engine best in class? Does management have depth and integrity? Is the runway measured in decades? Pass those tests, and today's price-to-earnings ratio is nearly irrelevant. You are buying the years ahead. And on those tests, the defining research compounder of the era is obvious: $32,000 into Nvidia. Its platform moat and relentless product cadence are exactly what the 15 points were written to find. 26 into TSMC, 22 into Microsoft. 4 names carry 92% of the book, held, ideally, forever.
The first big money lands on Nvidia, 32,000. Hold on, because the last chair is about to make that look timid. Stanley Druckenmiller, 30 years of returns and not a single losing year. The macro assassin, he reads liquidity, visualizes the world 18 months forward, and when he truly sees it, he bets like nobody else alive.
The Druckenmiller model gates every trade. Is liquidity flowing in? Does the 18-month picture look different from what the market prices today? Does the chart confirm? And if all 3 say yes, sizing is 70 to 80% of the game. You go for the jugular. Here, every gate opens on the same trade. $60,000, 60% of everything, into Nvidia, the one company the entire AI capital cycle funnels through. 22 more into Broadcom, the second shovel. The arms dealers, never the arms buyers.
Round 1 closes with a board at war. 2 legends just poured $92,000 into Nvidia, 2 others gave it exactly nothing. Hold that thought, it detonates in round 3. Round 2, forget who got the most for a moment, look at who got nothing. 2 names the entire board refused to fund, not underweighted, 0. Shutout number 1 is the crowd's darling, Palantir. 5 methods, 5 chances, 5 zeros. The most beloved software story of the entire AI boom could not get a single dollar out of this room.
The Graham screen does not need a second look. Around 50 times sales, roughly 80 times forward earnings. There is no price adjustment, no scenario in which a margin of safety exists here. This is speculation wearing an investment's clothes.
And the Lynch test fails in one sentence. You cannot draw 50 times sales with a crayon. A remarkable company at a price that has left the company itself far behind. Even the growth men walked away, and the second shutout is bigger still, a household name worth around $1.5 trillion. Tesla, 5 methods, 5 zeros, the most famous car company on Earth refused by every single chair. Why? It starts at roughly 190 times forward earnings.
The Munger model's verdict is short. Autos are a brutal, capital-hungry business. The valuation rests on a robotaxi future that does not yet earn a cent. A wonderful story is not the same thing as a wonderful business.
And even the board's risk-taker passes. No clean 18-month earnings catalyst. Binary regulatory outcomes. The present is already in the price, and the model does not pay up for promises.
2 more names barely survived. Oracle, the cheapest headline multiple in the whole group, scraped 15,000 because its enormous backlog is funded with debt. And AMD, the challenger, took 16, real growth, but the number 2 chip at a number 1 price. 2 zeros, 2 names scraping bottom. So where did $500,000 actually pile up? Round 3. Stack all 5 books into one portfolio and watch the bars build. 5 books, 100,000 each. Together, a $500,000 portfolio, the board's collective answer to the AI boom. We build it from the bottom up. At the floor, Palantir and Tesla, flat 0. Just above them, Oracle at 15,000 and AMD at 16, barely 3% each. 4 of the most talked about names in markets, drawing 6% of the board's money between them. Broadcom lands at 44,000. The second shovel trade, funded by the growth investor, the trader, and the stock picker, and a flat 0 from both value men. The first bar built entirely by believers in what comes next. Meta stacks to 65,000, the value camp's darling. Graham's biggest bet, Lynch's biggest bet, a Munger position, and yet both growth purists skipped it entirely. The mirror image of Broadcom. Now the top 4, this is where the board tears itself apart. TSMC, 70,000, and look at the badge. All 5 funded it. Value, growth, macro, every lens said yes to the one factory the entire stack must pass through, the picks and shovels nobody could refuse. Alphabet, 87,000, enormous, but the most lopsided bar on the board, built almost entirely by the value camp. The 2 growth purists gave the search monopoly exactly nothing. Microsoft, 98,000, and here is the quiet headline: it is the only name every single legend funded, and funded big, the true consensus, the least controversial way to own the entire boom. Which leaves 1 bar, the most funded stock on the entire board, and it is the one that split the room straight down the middle. Nvidia, $105,000, 21% of everything, the board's single biggest position. Now read its column: 0, 0, 13, 32, 60, 2 legends gave it nothing, 2 gave it almost everything, and nearly nothing in between. That is the paradox of this board. The money did not flow to the name they agreed on, it flowed to the name that most divided them, because the 2 who believed enormously. Conviction, not consensus, built this portfolio. And before the verdict, see the 5 books side by side. Same 10 names, same July 2026 numbers, 5 defensible portfolios that barely overlap. The numbers never changed, only the lens did.
So step back and look at what $500,000 just did. Roughly 21% Nvidia, 20% Microsoft, 17% Alphabet, and yet 2 of the 5 hold 0 Nvidia at all. Same 10 names, same numbers. Method, not price, decided everything. 3 things to take with you. The crowd's favorites, Palantir and Tesla, got nothing from anybody. The boring operating system was the only true consensus. And the most money went to the most divisive name on the board. At these prices, that is where the methods point. Rerun them with tomorrow's numbers and the board could move. The lens is timeless. The ticks are not. So, which legend got it wrong? Graham zeroing Nvidia, discipline or a blind spot? Tell me below. And tell me which company this board should split its next $500,000 across. These are AI models built from published principles. Not the people, not their quotes, not endorsed. Educational, not investment advice. Numbers as of July 2026. The methods are timeless. Rerun them with today's. Take your seat at the table. Subscribe.